Hey, Paul here. I'd like to thank our premier sponsor for this episode, Cisco Systems, building a bridge to possible in their newest platform to power an inclusive future for all. For more information, go to cisco.com. Welcome to Business Brains and the Bottom Line podcast. I'm your host, Paul D'Allegro, and I have I've said this a few times, very special guest, but I kind of do have a very special guest today, John Bullock, who is one of the founders and managing partner of Windspeed Ventures in the greater Boston area. Welcome to the show, John.
Thanks, Paul. It's good to be here.
Yeah, thanks. So I'm going to let the cat out of the bag right out of the chute here. John and I have been lifelong friends, and we have nicknames. So he's going to probably refer to me as Legs on occasion, and I'm going to refer to him as Bull on occasion. So we're going to flip back and forth. So I didn't want to confuse anyone out there. So we very rarely call each other by our first name. So just FYI. So we'll be good to go after that. So John, you're a venture capitalist. How did you get into the venture capital business? Explain your background and how you got to this point.
Well, first, thanks again, Legs, for having me.
Okay, you're welcome.
I wanted to get that out.
Yeah.
But it started out, as you know, and this way I can share with everybody. I was a computer science major and came out into technology. I started at Motorola, and then I got the startup bug. I went to a company called Wellfleet Communications, which was really one of those rocket ship startups where, growing, doubling every year, and had a tremendous time there. And once you get that startup bug, you can't go back. You go to other companies, but you're always, sort of striving to get back to that feeling that you had at the startup. And becoming a venture capitalist allowed me to do that, and do it in a way that was similar to what, get the feelings. I could live vicariously through the people in the startup, and I could still go home on weekends. So it was kind of a great combination of things. So I did Motorola, Wellfleet Communications, which merged into Bay Networks, and then started Windspeed Ventures with a few other partners to get into the venture game and try to help bring some of our entrepreneurial experience to the new. Many times it's a new entrepreneur who's starting companies, right, and we could help them out.
So to kind of set some definitions here, Bolt, we all here a lot of people are familiar with what venture capital is, and, A rounds, B rounds, C rounds. Give us kind of a brief description of what that means to the layman out there who's not familiar with it. And where you guys fit into that space, early seed, early round, late rounds.
Yeah. Yeah. So Windspeed is a early seed stage company. What we do is we look at, when you're starting a company, what happens is you need some capital to start, just to get an office, just to get a computer.
Right.
And usually that's an angel. You get people, you get friends and family who give you money. You get a few outside people that you can convince to give you money. And then you start your business. Then what you do is you turn and you try to start getting institutional money, which is where we come in, where you'll get early seed stage money. You might get $500,000. You might get up to $2 million,
right? Because
you have an idea that something is worth going. And then you'll go to a Series A, Series B, and each of those rounds typically gets bigger,
right,
as you go, until you get either some type of transaction where you're going to get acquired, or you go to do an IPO, or you can there's a number of routes you could take when you go from there.
So when the early seed money, I mean, is there a typical percentage associated with that? Like, hey, if we give you $500,000, we're going to own 50% of your company, or is it all over the board?
It's all over. It's all a matter of how much you're willing, the entrepreneur is willing to take. And what we try to do is, when we went into the business, was to help guide the entrepreneur and tell them that the first money that you take when you're an entrepreneur is the most expensive, because your valuation is low. So no matter what you do, any amount of money you have is going to dilute you significantly more from a percentage standpoint than if you had a $100 million valuation. If you take $1 million and your valuation is $2 million, you've just given away half your company. So what we try to do is tell entrepreneurs to take the minimum that you need to get to where you need to get your valuation higher, so then you can go raise the bigger money. And that's where angels come in. Angels a lot of times will give debt. Actually, it's a convertible debt. So that really you're not taking a percentage of the company until the company grows and then gets a bigger round, and then that debt converts in at that bigger valuation. So they're being nice about it.
Yeah.
For the entrepreneur.
So do you remember your first company that you invested in?
Yes. Yes, we invested in a company called apps.com, which, just for the URL was a great company.
Oh, I know.
But they were actually a company that was trying to be the central repository of apps, on the web. When this is back in 1999, 2000, when apps were really starting to becoming a big thing. The problem was that, in the year 2000, it was great. Year 2001 was not. And so the company was really not getting traction. We ended up selling it to Intuit
Right.
for a reasonable price at the time, although the entrepreneur, the CEO, wasn't happy with it at the time. But then when everything hit the fan at the late 2001, he thanked us because he realized he would have been out of business if he didn't do what we advised him to do.
Yeah. So to that point, Bull, you invest in a company. What do you get for that outside of a share in the company? Do you get a seat on the board, become an advisor? How does that all work?
Yeah, typically what happens is if you lead a round, you automatically get a seat on the board.
Okay.
So, if we go in at a Series A or a Series Seed, even is what they call it now, we'll typically get a board seat. And then when a Series A or a Series B comes in, they'll get a board seat as well. So you've got people who are representing each of the class of shares. Right. So the CEO is usually representing the common shares. You have the Series A investor representing the A shares, B shares, because sometimes there's a conflict between level of share.
Yeah.
So you want to make
that
sure.
Makes sense. Yeah. So you've been doing this for 20 years now. I mean, it seems like just yesterday you started this, by the way. I remember you telling me about this years and years ago. And wow, 20 years. It means we're getting older, by the way, just FYI.
Yeah. These stories start getting, although the stories get better as you know.
Of course, especially over a few drinks. I mean, even bigger, right? But in your case, I mean, you've had a pretty great ride. I know in particular, some of the businesses that you've invested in and some of the sales that you've made and some of the companies that have gone public. And so you've done very well. I mean, tell us a little bit about the ride. I mean, and some of the companies you've invested in and go from there. Yeah,
it's, in a way we thought at first we were like the unluckiest group in the world when we put the group together, because it was in 2000 and 2001 was a disaster. The good news was we were so paranoid about investing in 2000 when we raised our fund that we really didn't do a lot of investing. So when 2001 hit and there was a downturn, we still had a lot of capital to invest. Okay. So we kind of lucked out.
You planned it that way. Come on.
Yeah. We tell people we plan it that way, but no, it's pure luck. But we found some great companies, some great people. We've had three major funds that we've supported over that period. And then we also, on the side, we picked up in 2004, what happened was we were trying to raise a second fund based on our first fund results, which were actually very good. And but we were unable to raise it. We were still too new to the game to raise the fund. And so we went looking for distressed companies because there was a lot of distressed portfolios out there that just got hammered with the downturn. And we ended up running across this one called Windspeed Ventures, which was basically the company itself was going bankrupt, and they had all of these assets. They had real estate assets, they had legal assets, they had equity assets, debt assets, all sorts of things that they had to liquidate for the bankruptcy. And we got their portfolio and we convinced them to let us manage it. They wanted to sell it, and we told them, you're going to get 15 cents on the dollar if you sell this right now. If you let us manage it, you've got about 3 or 4 years you still have left that you have to dissolve all your other things. Let us manage it over that 4 years, and I guarantee you'll have at least 3x what it's currently carrying it at. And we actually convinced him to do that, and it was a great deal. It was probably the biggest portfolio in the country from a company standpoint. It was 550 positions in 256 companies. So we basically inherited 256 companies in a portfolio. Nice. So think of the triage you got to do to go through that to figure out where things are. And there were some great ones. It's OpenTable, Shutterfly, Ebates was one of them. Salesforce.com was in there. So there was some real, blue chips are in there. There were also a lot of dogs, but
Yep. Well, and you only need a few of those to really hit it big to make all your money back, and then some, right?
That's right. Yeah, and we weren't sure, what was going to happen, but we knew there were some good companies. But it started. What happened was about a week after we closed the deal, a company called Red Envelope, which was an e-commerce site, went public, and so we're like, "Wow, this is easy."
Yeah.
A little while after, Blue Nile went public. A lot of e-commerce sites were doing that, and they were getting big valuations in doing that. So we thought this was like, but then you get the lulls, and you get all sorts of things. And one of the challenges we had anyway was that the company Comdisco, while they were going through their bankruptcy and just before it, they had a lot of debt holdings in these companies as well as equity holdings, because what they would do is they would go in and follow up all the big VCs and put $2 million into everything that all these major VCs were doing. And then they would go back, because they were really like a debt financier or a leasing company. So what they would do is, hey, who better to give you a leasing contract than one of your investors? And so they would get that. But when people wanted to renegotiate their debt, they would say no. So we would call up and say, hello, we're Comdisco, and they would hang up on us.
Oh, wow.
So we would have to go through the venture group, tell them who we are, tell them we have extra money. We want to invest in any follow-on rounds possibly. So we actually raised a side fund to invest in the Comdisco portfolio. We called it our cherry pick fund, because we had pro rata rights to invest in all of these 256 companies if we wanted to. So it was fun.
So out of those 256, do you have any left over today?
There's one.
Wow. So I'm sure some of them went belly up, right? That's
a majority of them did.
Did they? Okay.
But
what was your biggest one out of that group? The biggest win?
Biggest win was a company called Spidera got acquired by Akamai.
Okay.
And then Akamai ended up, obviously Akamai grew. By the time when they bought them, we got Akamai stock, which ended up growing to, before we could liquidate, a lot of money.
Yeah.
And so we ended up, the whole portfolio got about between 6 and 8 times its original marked price that we started with. Yeah.
So the Comdisco folks, they had to be happy.
They're happy. Yeah, we're happy. It was a great relationship. But it was chaotic, because it was that many, we were getting months after we started it, we were getting calls from Chicago where the group was headquartered. Hey, we found these other stock certificates. Can you use them? Yeah, just send them over. We'll take care of them. We'll figure out what to do with them. But it was they were great people, and we had a great relationship through that.
Oh, that's great. So Bull, you had 3 other partners when you started, right?
Right.
Did any of them have any venture capital experience?
One did. One actually worked for Mike Milken, actually back at Drexel Burnham in New York during the go-go days of the 80s.
Sure.
So he had the biggest background in finance. The other two were a marketing and an engineering leader in a startup company. And so the 3 of us were more the entrepreneurial, hey, we're startup guys. Dan was the money guy. Dan Bathon was the partner that was the money guy. And we made it go for 20 years. Yeah.
And then you learned as you go, right?
You do. It's
How has the venture capital business changed, do you think? Because with technology changing and everything's changed over the last 20 years. How has that affected your business?
Well, it's not as much fun. From an entrepreneurial standpoint, I think it's great because, what's happened is with cloud computing and, cloud-based systems, you don't need as much money to start a company. And in the old days, you needed to buy a PBX for your telephones. You needed to buy servers for your computers and networks, and you needed all this hardware.
You need all the infrastructure.
Yeah. Now for a couple $1,000s, you can set up an office and have it networked and phones and everything going on. So you can start your process to develop. And then, and secondly, the services that you want, if you want to have any type of applications, those are all being done through the cloud as well. So you don't have to buy a a blanket agreement for 400 people. If you have 4 people, you can just
Right.
pay as you grow. So from that standpoint, it's great. And as what we're seeing now also is software as a service if you're offering software as a service, it's a lot easier to get customers because again, you don't need to get a $1 million contract from one customer. You can just do it on an as you go. You tell me, $10 a month per employee for this type of application. You can grow, you get a monthly recurring revenue, and everybody loves that. Right. So
Yeah. I mean, as you know, I'm in, the IT business as well, Bo, and there's a big movement to that. Everything's going to subscription,
Yep.
service-based offerings. Because if you look at, and I'm not, I don't have firsthand information on this, but if you look at HP and Dell Technologies, they're trying to get away from the hardware business.
Oh yeah.
They're shrinking their sales forces on the hardware side, and they're looking to do everything in the cloud right now. Everything is a subscription-based offering. So it's kind of in line with what you're saying.
Right. Well, if you look at, just look at the comparison. If you do $1 million in monthly recurring revenue over the course of a year, so you have $1 million, year 2, you're starting out with $1 million of revenue if you keep everybody,
right,
retained. In the old days, it was you do $1 million of sales in a year, you might get 20% maintenance, so you get that 20% next year.
Yeah.
But essentially, you're starting from zero again.
Yes.
Every year.
Yeah.
And so your growth can be exponential relative to what it used to be.
Yeah.
And so that's the good news. The challenge now is that venture groups are now putting that multiple on those types of companies. So for me to get into a small company who's doing software as a service, the multiple now is, 3 times, 4 times what it used to be. So they might be running at a 5 to 10 times revenue.
Right.
Valuation.
Yeah, so that's kind of the numbers that I heard. I've worked for some companies over the years that try to position themselves as a software company. And so that the multiples are much higher versus if you're selling boxes, right?
Right. And so I don't want to do that. I can't, we're small. We're trying to keep small money going in. And so I don't want to play that game. So that's why valuations are just getting too big. And what happens is when the valuations are that large and the company stumbles, it's just that much farther to fall. Sure. So, and companies do stumble. So it's a lot riskier for a small venture group. You really got to have deep pockets and be ready to go along the long route if you're going to do that.
So when you're looking at companies, obviously, I mean, I've been to your website. There's 1 million companies that you guys have invested in over the years. Mm-hmm. What do you look for? Just, I know some of the things are going to be obvious, but overall, when you look at a company, how do you evaluate it to say, hey, this has a chance or it doesn't have a chance?
Right. Well, so I'll go through the textbook answer first.
Okay.
Which is a company, a successful company needs 3 things. You need a market for whatever product that you're developing. There has to be a market that's going to accept it and be able to do it. And you need the product. You need the product to work. You need the product to be acceptable, that can address that market. And then you need a team that can execute. Right. So if you can execute with a product into a market that's willing and able, you're going to be successful. That's the book. But obviously, if you go by the book, every company's successful because
right.
So
what to say that?
What I've found personally is the differentiator is always, if you want one of those unicorn startups, it becomes leadership. Yeah. You need somebody in there at the helm who can make the changes, can understand, can say no to things, because a lot of times people can't say no. We're going to sell to them. We're going to sell our first unit in Russia, and then with second unit in South America. No. You got to say no to some things. You got to figure out what you can do and where you can do it. And it's, if you look at, I've seen many successful, really big companies who have succeeded. And if you go back, what is the constant? It's usually the leadership.
Yeah, I think that's a great answer, because I mean, we've all got have experience at different companies over our lives, and I would agree with you on that. I look at the people, the companies that did well. They have great leadership and great morale and great people over from top to bottom.
Right. Yeah, so,
well, if a company wants to start up, I mean, and this kind of ties into what you're saying, what would be the advice you'd give them? You know, as you meet with companies, what do you tell them? What's the advice you give them?
Well, if I've got, I'll look at the technology, I'll look at what they're trying to do, I'll look at the market they're trying to address, the business model that they have, all the regular things.
Right.
But what I'll tell them is, you need to make sure you have a team around you that understands the market, understands the vertical that you're in, because a lot of times they may be technical, but it's, if you're addressing a logistics market, you have to have someone who speaks logistics. If you're addressing the computer market, you need someone who can speak that language, and they're all different languages. Make sure you have that expertise on board, and then hire people smarter than you to surround yourself. And if you can do that, and you have the right, all the other things click into place, and the other thing would be, don't be so egotistical that you're not willing to step aside if you're the entrepreneur, because you have to have a leader who's going to take you to the big time. And that's rare. Not many people can do it. So if you find someone who can, you jump on it.
Yeah, I think one of the famous stories is Ben and Jerry's, right? Mm-hmm. They made ice cream, but they eventually had to hire a CEO to run the company, because they were just, got a couple of guys out of Vermont making ice cream, a great ice cream that did very well. But at some point they had a business to run, right?
Right. Yeah, no, it's, and it's historic. I go back to Wellfleet, and the reason that Wellfleet was so successful was Paul Severino, who was the CEO. He was, and that company was a rocket. It was, luckily, the internet helped.
Sure.
But there was a period back in the 90s where, Fortune 500 does a fastest growing company in America every year. They do this whole thing. They do the top 100 fastest growing companies. Yep. And Wellfleet was the number one company one year. And then it was the number one company the next year.
Oh, wow.
Do it 2 years in a row is just, and the company was pure Paul, right? He was the one that drove it. Everybody wanted to be like him, and just whatever he thought, they reflected. And the alumni of Wellfleet has gone on to, the people who were there are now CEOs, CXOs, venture capitalists. They're all over the place.
Yeah.
And they've all had, a lot of them have had great careers. But if you go back and you say, well, what was your most satisfying and fun experience? They'll all go back to Wellfleet, they'll say.
Really?
Well, no matter what they've done, because it was just such an experience.
So what number employee were you at Wellfleet?
I was 24.
Wow. So you were within the first 6 months to a year?
No, it was a little over a year, but they hadn't had a product ship yet. So they were still pre-product, pre-revenue when I get in. But when I left, it was about a little over $2 billion company.
Right.
So it's quite a ride. Yeah.
And aside from Paul, it was mostly you, Bull, right?
Yeah. That's right. Yeah. No,
that's what I'm telling everyone I know.
I was just, I was just a player in that game, but it was such a fun game.
Yeah. Well, that really kind of bankrolled into your current role for the most part, right? I mean, all the stock you had, that sets you.
When you get an IPO done like that, it kind of puts you in the club.
Yeah.
Right. You've been in a successful startup, you get some capital, you can start, you have options of what you can do. And that's part of what we did. When we started Windspeed, it was 4 people coming off, I had my IPO earlier. They had just come off, my partners had just coming off an IPO more recently in 2000 or 2001.
Right.
So they were, we all had capital, and we were able to raise capital and do what we needed to do.
Well, give us a few more examples of some of your big wins, Bo. I know you've talked about Severino at Windspeed, but there's got to be a bunch more that would be recognizable to the folks out there, I guess.
Yeah, sure. And again, a lot of the big ones, I'll mention the CEO as well, because they're so critical to it. One of our first investments was a company called Vistaprint, which was we led their Series A, so we were the first money in. And Robert Keane is the CEO, and we were in Waltham. We were in Lexington. They were down in Waltham. They moved to Lexington eventually, but we got a call. We got connected with Robert, and Robert told us, "Why don't you come down and visit? I want to show you how we can make 30% margin on free business cards." We're like, "Whoa, okay.
That sounds like magic to me.
You know what? I don't think he can do it, but it could be interesting to see. So we went down, and these guys, what they did was they took an old industry, the printing industry, which was, mom and pop shops for years and years. Yep. And so they were able to leverage these big Heidelberg presses that you usually use for Hershey bars, tens of thousands of Hershey bar, printing. And they were able to print business cards on them, individualized business cards for people. And they could do it at the cost of printing a Hershey bar wrapper. So it was the way they were doing it was ingenious. And then leveraging the internet made it all possible. Like what you could do is you could sort, you just hold off and schedule your jobs so that all your blue ones come together, all your red ones come together. So you're not changing ink, you're not doing that. And they're currently still in business. They're doing great. They're probably a $2.5 billion company right now, worldwide. They're called Simpress now, but Robert's still in charge. So he's
wow,
done a great job. Yeah, we were. They went public. What was it? Highland Capital came in for $50 million just before they went public. And so a lot of people, everyone talks about Vistaprint. They go, oh yeah, it was a Highland deal. And we're like, wait a minute, no, it was a Windspeed deal.
Oh, funny.
But that was a great run. And so another one, I got in late. It was kayak.com. A friend of mine, Paul English, was the head of Kayak. He was sort of the CTO at the time. And again, Paul's the type of guy that he's had a number of successful businesses, very big philanthropist and in the Boston area. But what they did was they went into an industry that was, all of these airlines and travel sites were battling each other. They're all competitors, like, Priceline or Travelocity. They would buy blocks of time for airlines, and then they would underprice the airlines. It was crazy. And so what Paul knew was, if you get the airline travel business, you get the hotel, the rental, all the ancillary stuff, and those are a lot more profitable. So you can do it a loss leader and get the airline thing, and then don't worry about it. So he went to the airlines and said, look, you let us into your reservation system, which they wouldn't let anyone else in. You let us into the reservation system electronically. Anyone we steer to you give us $1. And the airline's like, yeah, hell yeah, let's come on in. And so they set it up, and the company ended up going public, and then was acquired by Priceline, I think it was, for $1.8 billion. So it was he just did a tremendous job, and that's just a business move, right? It wasn't even really technology. There was some, obviously, but
someone had the idea and made a decision.
Yeah, just a business model thing that just did it. And then we've got one now that Jump Cloud out in Denver, out in Boulder, Colorado. They're a cloud-based directory server. So you can, you don't need to buy, Microsoft servers anymore. You don't have to do any of that stuff. You can do it cloud. It's what we were talking about earlier. Yeah. Having the ability to just sign your people up, put them on, and again, it's Rajit Bhagvara.
Say that 10 times.
Yeah, right. But he's great. He knows every detail of the company, what they're doing, when they're doing it, what they need to do. It's amazing what's going on. They've raised about $165 million so far, and they're going gangbusters. And just he's done it 4 or 5 times. He's done these successful startups, and he actually has a book, the Startup Playbook, that I'll throw a plug in for if anyone wants to read it. It's an actually excellent book for entrepreneurs coming into it, that he's put out. And it's more of a, it's more common sense for people, who are starting companies to understand what's going on. And he does a very nice job of doing that.
Cool. So I can't let this episode go by without mentioning our upbringing. As you know, as we mentioned, we're both from East Somerville, Massachusetts. And when I had Bobby Martini on, I mentioned this, that when people ask me where I'm from down here in Texas, and I say I'm from Somerville, unless you're from Eastern Mass, you're not going to, and they say, well, what type of town was it? I don't really know where to begin, because it was quite a unique place to go, very inner city, a lot of, a lot of blue collar, a lot of tough neighborhood, a lot of people going to jail. And so in that environment, how do you think that's helped you in your career? Because I think it's helped me, that's for sure. But I want to hear from you.
Well, there's a couple things I think that helped. It was funny because growing up, it was always Slummerville, right? And we were like the lowest of the low, and you're sort of embarrassed. And then that whole Winter Hill thing that was going on, and then all the movies that came out. Then I'm in businesses, and they're going, "Oh, Winter Hill gang." Oh, like they have a respect for me. I'm like, wait a minute, this is not the.
This is not us.
Yeah, but it's hard. You tend to, especially in this business, one growing up not too affluent, you're a lot more driven to succeed. I was the first one in the office in most of those companies, any company I've been in, and usually the last one to leave, because you're just going to show what you can do, and you feel you have to do that blue collar work ethic and work harder.
Yeah, that's the way we were raised.
Yeah, and there's things that, there's a lot of pedigree in, especially venture capital. I'm not a typical story to go from Somerville to public colleges to Fitchburg State College to business. It's so you have to have that little extra. There's one funny story I'll give you. We were in front of, at the beginning of raising money, we were in front of the Harvard endowment, and I don't know who the middle manager was who was determining whether they were going to invest in us or not. But we were giving our pitch, and we were doing well. So he starts going through the bios, and he's going through the partnerships, and he's like, okay, Villanova, Brown, Fitchburg State, We don't get a lot of those through here. Yeah. And then for the next 5 minutes, it was all, my sister went to Fitchburg State. She's a nurse, and So, eventually I sort of had to turn and say, look, you don't get to hear from Fitchburg State by being average.
Yeah.
And he goes, okay, I'll give you that.
Good point.
So we never got the money, but I walked out satisfied at least.
Yeah. Yeah, it is funny. You've told me that story. Not exactly. Maybe it wasn't that one in particular, but working with guys from Princeton and Brown and, Harvard, and all of a sudden Fitchburg State. And so for the listeners out there that don't know Fitchburg State, it's in Massachusetts, and it's part of the Massachusetts State College system, of which I'm a graduate too, but I went to Bridgewater. You went to Fitchburg. Because quite honestly, at the time, that's all we could afford.
That's right. There wasn't,
there wasn't many guys in our neighborhood going to Harvard or Boston College or, some of the more expensive schools in the area.
Well, it wasn't even thought of.
Yeah.
The limit was, just getting to college was an achievement. So any college you got in was a plus. And that was the sort of mentality. And that's a shame, because it still exists in a lot of cities in this country. This is how high you go. If you can get onto the DPW, you've succeed. Forget college. Become a fireman or a policeman. Not that there's anything wrong with those, are noble professions, obviously, but and I've talked about this before. I mean, we grew up a certain way. We weren't born on the right side of the tracks, but we've done well for ourselves, and hopefully we've provided our kids with a better life, and hopefully they'll provide a better life for their kids. Right. That's right.
And that's the whole game. But I'd like to touch on something too. So growing up, I'll tell you, growing up in the city, you always were looking over your shoulder at something. And to me, one of the biggest things I got out of was, I think I'm a good judge of people. I can spot a phony a mile away.
That's right.
And I'm sure in your business, there's a lot of phonies, right? A lot of.
That's right. And again, I'll go back to Paul Severino. He was from New Jersey, city, New Jersey. So we got along very well. Yeah. Because you get that city street smarts, and people would ask me, they go, how do you judge? You judge people very well. You're in a meeting, who's who and what's what. And I said, well, here's the deal. When you were growing up where we grew up, and you're walking down the street and someone was coming the other way, and you'd look up, you'd have to make a decision. Do you just walk past this person? Do you cross the street to kind of avoid them? Or do you just turn and run the other way? Right. Yeah. So you were always on guard. Yeah,
it was. It was amazing.
It helps. As hard as it was doing it, it certainly has helped, long term in assessing people and character. You can see character right away. No matter how nice someone is on the surface, you can usually see underneath that, oh boy, no, this is not gonna work.
So I had a touch on that, because I think it's been I look at it as a plus where I grew up. I mean, it would have been nice to have millionaire parents, but unfortunately, we didn't fall into that category.
Right. The shame is there's a lot of people who didn't get through. It's one of those in these environments that are truly, kind of down and out, which is where it was at the time. A lot of people fall by the wayside.
Yeah.
If you get through, it's an advantage because of the street smarts that you gain, but there's a lot of, casualties that go along with that.
Yeah. No, good point. All good points. But so, we're both getting a little older, Bull, not too old, but, what's next for you? I mean, from a financial standpoint, I'm sure you're very stable. You don't have to work anymore, but I know you're pretty busy right now and some of the conversations I have. So what's up next for you? What do you got going on?
I had fun doing the venture thing but it was kind of, and again, I'm looking in from the outside with venture, right? You don't get that same rush that it was, when you're in it. So I'm advising a company now that I'm going to start doing a little more of that. I've got a threefer. It's a great company. It's a robotics company. It's also an eco sustainability play, and it's another company similar to Vistaprint, where it's a new technology that can potentially change the entire industry. This is a 150-year-old industry. So this is a robotics box on demand company, and what they can do is they can create a corrugated box of any size you want within seconds. So, if you look at what's going on today, there's 80 billion boxes get shipped every year over the last year. Of that, 40% of those boxes are typically air, which means you have to put filler in, bubble wrap, all of the different things, which are all landfill, creations. There's waste in the corrugated. If you can get a right size box, you don't need as much of the fill. You have a smaller footprint of the box. So now on your, those Amazon trucks that are coming to your door, you can fit 20%, 30% more boxes on one truck. So you're doing less gas, you're doing less recycling, you're doing less. There's so many benefits to it across the whole spectrum, that this thing it could be a game changer. And
no doubt. I mean, obviously any project that a company is going to take on has got to cost justify itself. So that's just a basic arithmetic equation at that point, along with the eco benefits, right? Right.
A lot of them it's almost balanced now because there's such a paranoia. I'm saying it from a negative standpoint. There's a need to be carbon neutral.
Right.
And for to say that you are and you're good. And some of it's, I look at it from a paranoia because they're afraid, because it's so easy for a group to decide this company isn't eco-friendly, we're going to boycott them. And then
then you have the cancel culture. Right.
So people are the sustainability aspects of this product is almost as important as the cost savings that they get.
Right.
And you give them both, they say, oh yeah, good. Then it's a no-brainer.
That sounds, so you're saying you're counseling for them right now? Do they actually have a product out there?
They have a product. They'll be in pilots by this summer. So they have, demonstrable product, but we got to get it all put together so that they can get into shops and show what they can do. But you look at it, it's almost a joke now. You see the Amazon box come to your door and, you bought a tube of toothpaste and a toothbrush, and the thing is in a 10 by 10 by 10 box. You open it up, you're pulling up all this stuff. You're like, what is this?
Well, think what happens. The guy in the warehouse that's filling orders, he's probably just grabbing boxes left and right, just by guessing, right? I think this will work. And, but if you have someone,
they'll take all the products, they'll pick them, put them on a conveyor belt. It goes down. Someone gets whatever the closest box they can get.
Right.
And they put it in. So think about that. If all of a sudden you have that conveyor belt, you've packaged you put everything on the conveyor belt, it goes down. Now it's scanned. Automatically a box gets generated. This goes right in the box, pure fit. You don't have to worry about any of the excess stuff. Gets wrapped, off it goes, and you've just saved all of that other aggravation of waste.
Yeah, well, good luck with that one.
Yeah, thanks. It
sounds like it's a winner. The only thing that could probably do
now too, it's kind of cool. It's back to Somerville.
Well, it's funny you say that, because I think this pandemic has taught me one thing. I'm not sure I want to retire.
Yeah.
Because sitting at home all day, I mean, I go to the gym every morning. I get to see some people, but not making sales calls. You're on the phone all day and you're in your house all day. And I'm like, well, if I didn't have this to do, I'd really be bored. So I'm not sure. I'll retire when I want to, I guess, not when I'm forced to.
That's right. Well, we're similar. Our group is similar, right? We're young. We're still kids.
Yeah.
In our head. And as long as we're together, we continue to be kids. So, which is a good thing.
Yeah. And our wives think the same thing, by the way, just so you know. Well, so if someone would want to get into contact with you, Bull, how would they do that? So maybe there's a company out there that's looking for some help or what have you. I mean, how would they do that?
I can get, they can get hold of me through Windspeed.
Okay.
It's John at Windspeed. You send an email, I can, I'll look at it, see what it is. I'm not doing a lot of new investing, but we're, anything I can answer, I'm happy to. Cool.
Well, any other last pearls of wisdom for our listeners out there?
Let's see.
Patriots aren't going to win the Super Bowl this year.
No, they're not going to win the Super Bowl.
That's my pearl.
Yeah. So when do we do this again? Can we just do all of our childhood stories?
Well, we could do that.
Do podcasts have ratings?
Yes, they do. You got when you post it, you gotta like rate it, right, for children and not for children. So yeah, this may fall under a different category, but I'm not sure our listeners out there would be too interested in hearing our childhood stories. Although as we find them entertaining, I'm not sure the audience would. But we can do one. I'd like to have all the Somerville guys on for one. That would be funny.
That would be a trip. Yeah, that would give people a flavor of what it was really like.
Yeah, cool. Well, Bull, thanks again. Thanks again for your time. I've been wanting to do this for a while because I thought, the venture capital game's an interesting one. And, you've been doing it for such a long time. I thought it would be a fun one to do. And I hope the audience will enjoy it. I think they will.
Yeah. No, I hope so. And like I say, if there's any follow-up questions, they can shoot an email and I'm happy to, explain what I meant.
Yeah, there you go. So, well, hey, that's a wrap for Business Brains and the Bottom Line. And this is Paul D'Allegro signing off. Until next time.
Thanks, Paul.